I guess the key indicators to me of the state of the market is that and to understand or to have perception of what's going on that's true, we have to look at signals outside of the price action. Although, I mean, the price action has been tremendous this year. You know, it's
Today we bring you something special. We're joined by precious metals expert David Jensen, and this one is packed with eye-opening insights. He breaks down what's really happening in the gold and silver markets, explains the signals flashing through backwardation and lease rates, exposes the role of ETFs and market manipulation, and reveals the truth about growing physical shortages. And most importantly, David shares where he believes silver and gold are heading next. If you care about protecting your wealth, this is a conversation you need to hear. So stay tuned right till the end.
started the year at 29, and I think we're 47 right now, right? So what's that, like 60% increase in the price of silver in 12 months? So tremendous. But you know, this market is dominated with price setting in the UK and London, and that's a promissory note, cash or spot market. You don't have to have the metal to sell immediate ownership of metal to somebody else, and that's led to, you know, scary numbers in terms of the open interest and the, you know, the number of claims standing in the market and the trading volumes. I mean, the London in 2011 did a survey of traders, and you know, getting 62% of traders responding. They said that, you know, our actual volumes are 10 times higher than the numbers that we've been posting, you know, since I think 97, they started posting their volumes. And so that meant that they were trading like, you know, 1.5 billion ounces of silver every day. And, you know, if you use a 2 to 3 times multiplier of trading volume versus open interest, that meant that there was, you know, 3 to 4 billion ounces of claims for silver in the market. Now that's just overboard, right? That's just insane when you look at a market where total mine supply is like 825 million ounces a year, right? Like, it is clearly a paper market. And so we have to look to indicators outside of the price action, and the numbers, you know, they basically just push a few crumbs under the door in terms of data that they release there every month. But what we can see is things like price backwardation, which is the spot price versus the futures price. And we can see now that we've got price backwardation where the spot price is higher than the futures price all the way out to 12 months. And that means that there's a demand for metal right now. We want that, you know, we're happy to pay more for the metal, despite the cost of storing it for 12 months. If you look at a 12-month cost of storage, they're willing to pay more for it in the spot market than they would be to buy a futures contract. So that, and then also the lease rate, that the lease rates, pardon me, are now, you know, over 5% all the way out to 12 months as well. So that's signaling distress in the market. Those two numbers there alone are signaling there's a physical market distress in the market. And I think it's been going on long enough now, over, like, we've got 3 years of 800 million to 1 billion ounce deficits. And then before that, it extended for a couple of more years. But the available physical supply has been eaten up over time. And we've now got the tightness to the point now where the market, the promissory note market in London is being squeezed so badly by the physical shortness that you can't, you know, the old thing about slamming the market with shorting the market with paper promises. Well, it doesn't work when what people want is physical metal. And if you try to slam the market by selling notes into the market for delivery, people say, okay, well, we'll take the metal, and then you face default. So that's what's terminated that game, Craig.
I've always described it as the fractional reserve and digital derivative pricing scheme, and that unallocated metal is kind of the bane of our existence, but also of the precious metals markets, and that the market relies upon that hypothecation, rehypothecation. And, you know, our friend Chris Marcus has done a lot of work trying to figure out what is the actual size of the available free float for silver at the LMA. He thinks maybe it's only 150 million ounces. Do you have any thoughts on that?
Yeah, like since May, the portion and these you have to trust. I mean, this is assuming that the numbers that we're being given are correct.
Right.
But the vault holdings of silver in London have been that aren't held by ETFs have remained basically constant since May of this year. And that's despite the fact that there's a global shortage of physical silver bars in these exchanges. So what I'm taking, so that's been shown at 140 million ounces, Craig, since May, and it's not moved. And so the issue is that you go, well, wait a minute, the lease rate is shooting through the roof, and we've got backwardation in the market, and we've got a global deficit this year, 300 million ounces in a billion ounce market. Why is that vault stock not being drawn down?
Yeah.
And the conclusion I've come to is that that's not available to market. That's held in the vaults, but that's held by private owners, and they're not providing that metal to the market. If they were, that would be drawn down to meet the global demand. Well, I think if you look at the fundamentals, if we start there and we say, we've got 5 or 6 years of ongoing silver supply deficits, and the deficit this year is of the order of, I think, 200 million ounces or 250 million ounces. We see the surging lease rates now.
Yep.
And then we see the price backwardation. Like, all those three things are supportive of the fact that there is a true market shortage for silver. And then again, if we look at the float in London of silver and the fact that that has not moved now since May, indicating that metal is not available to market, we say, well, the silver has to be imported. And, what are your sources? Well, the refineries and the mining companies. But I mean, that metal was already spoken for. When you looked at the supply demand structure for the year ahead, and the fact that many of the industrial users, they buy through metals brokers who have contracts with mining companies and they've secured the metal, right?
Right.
So I think fundamentally speaking is that we see this building tension in the market, and the fact that it's been building, for half a decade now, really, in intensity, tells me that this is not a speculative a paper market artifact, that it's something created by supply demand imbalances, and that physically available 1,000-ounce bars, as are needed for trade settlement in the markets, are not available in the size required to meet the market demand. So I think the market, and also if you look at the parabolic price movement now, in conjunction with this physical metal shortage, it tells you that there is something true there in the market which needs to be addressed by higher prices. Nothing solves it better than higher prices, right? So, but the issue is again that silver is a giffen good, as is gold, and as the price moves higher, it increases demand, and you need higher prices for a long period of time in order to resolve the price and the high price and the supply demand imbalance. So, I mean, if we throw into it on top of that, Craig, the fact that there's, from what I can see, there's well over 1 billion ounces of these unbacked claims in the London market for silver standing, is that you've got a situation here where, we can have extraordinary price moves now. And this comes, on the end of this market was starting in 1987, the LBMA.
So, as David Jensen explained, the signals in the market, the shortages, and the manipulation all point to one thing. Gold and silver are heading into a powerful new chapter. The question isn't if, but when. If you found value in these insights, make sure to hit that like button, subscribe to the channel, and tap the bell icon so you never miss these critical updates. Thanks for watching, and we'll see you in the next video.